In today's retirement makeover, we're going to take a look at Chris's situation. Now, Chris and his wife have done incredibly well at a really young age, and they're looking to retire. Now, despite the rosy projections, Chris and his wife are a little bit more conservative naturally. So they're asking the question, what can go wrong? Yes, the projections say we can do it, but what risks do we need to be aware of that might potentially derail this? So in today's video, we're going to look at the 7 retirement risks that everyone needs to be aware of so that you can see where these risks present themselves, as well as what you can do to protect against them. In today's video, we're going to start by pulling the cover back on Chris and his wife's actual financial situation, reviewing their real numbers. We're going to look at their projections to see what they're on track for, and how might these risks come in and present a problem to Chris and his wife, as well as what can all of us do to alleviate these risks. So let's jump into Chris's actual situation. As we can see here, Chris and his wife have a net worth of about $4.7 million. They are both 40 years old, so very young, and they're looking to see, can they retire? Their net worth is comprised of various cash accounts, investment accounts, restricted stock, Roth IRAs, 401ks. You can see that all right here, but pretty well diversified into different types of accounts, into property, and this is where they are as a snapshot. 40 years old with 4.7 million. The goals that they have are to retire as soon as a year from now. So they don't know exactly if they'll want to continue working past this point, but what they really want to do is have the freedom to travel, the freedom to do what they want to do, the freedom to determine, do they want to continue working? And they're wondering if they're in a position to do so. When they do retire, their monthly expenses will be $8,000 per month. Now, that's kind of like a core expense, meaning that's an expense that they're going to have at age 41, as well as at age 61 and 71 and 81 and even 91. In addition to that, they want to have an extra $18,000 per year for the first 30 years of retirement. Think of these as the go-go years. If you're going to retire at 41, you probably have a lot of life and energy and things that you want to do. So this is an extra amount in addition to the $8,000 per month that they want to have to fully pursue what's important to them. Then they have another $24,000 per year, $2,000 per month for travel. So that's going to allow them to take the trips that they want to take in addition to some of their core spending. Now, beyond that, we need to factor in other costs, things like healthcare. So here's the healthcare cost that we're planning on for them. Here's a long-term care cost we're planning for them. Now, these long-term care costs might not happen for another 50 plus years, but we need to include them as part of their base case plan to see what would this look like if there were to be major expenses. Then they have goals to send children to college, and you can see what that looks like. They have new car purchase goals. And so we won't go through each of these line by line, but you can see they've really thought through what is it going to cost for them to live? What's the extra cost for those go-go years, which we're looking at here? What's the extra cost for travel? Then what are those extra costs for healthcare, for long-term care, for sending kids to college, for those new vehicles, for various things along the way? The income sources that they have. So today, they've got a strong income of about $350,000 between the two of them. That income, of course, allows them to meet all their needs today. However, that income is going away within about a year when they retire. So after that point, they'll both have Social Security, but Social Security, there'll be a significant gap between the time that they retire at 41 until they actually collect Social Security. They'll have a 25 plus year gap until any income actually comes from this. They do have some private real estate loans, so you can see the income that's being generated from that. They both anticipate an inheritance, and these inheritances, of course, none of us really know when this is going to happen, but they're projecting 2054 for spouse's inheritance, also 2054 for Chris's inheritance. So a combined 1.3 million or so down the road in projected inheritances. I'm including something for part-time work here, assuming nothing to start with, but just so we can model out what would things look like if they do potentially work part-time. Savings. So today they're saving quite a bit. They are maxing out Chris's Roth 401k. They are then putting 12% into Chris's after-tax 401k, which you can see here. They then do an annual conversion to the Roth 401k. This concept is called a mega backdoor Roth contribution or mega backdoor Roth conversion. So they're doing that as well. They're both taking advantage of backdoor Roth IRAs, and they're maxing out health savings accounts. So they are definitely prioritize savings to tax-free accounts, not tax-free going in. Now, with the exception of the health savings account, they're not getting any deduction for these other contributions on the front end. The benefit is they're saving money to accounts that are going to grow tax-free for the rest of their lives. So that's a snapshot of where they are. We've looked at their current assets today. We've looked at their goals, the big one being they want to retire in a year, and we know what they want to spend money on. We know what their income is today, and we know what their income is going to be in retirement. And now we can see their savings The next thing that we want to do is we want to understand, is this doable? Can this happen? Now, by the way, if you've watched any of my videos before, you know that before we actually get to this screen, we go through a year-by-year cash flow analysis to see income coming in, expenses going out, what the withdrawal rate might look like, and that all builds up to this point here. What's a snapshot of what their portfolio might look like over time? I'm not going to go through all of that on today's video. Go check out the other videos if you want to see how I do that. In today's video, I want to focus specifically on the risks here, because as you look at this looks really good. Chris and Chris's wife, here's a snapshot of their portfolio value today. It's projected to continue growing over time all the way up until age 100. And after several years and decades even of compounding, not unrealistic to think they might have millions and millions of dollars at the end of their lifetime, even more so than they have today on the front end of retirement. So what's the deal here? This all looks good. What are we so concerned about? Well, this is making some assumptions about what the market's going to do, and everything that we're assuming, of course, is going to happen exactly as it's assumed. The reality is that will never, ever be the case. Even if we just looked at the probability of success here based on different market environments, we're looking at a probability of success of 70%. Now, this begs the question, is that good or is that bad? Well, I will say that Chris and his wife are in a very good position. This 70%, what this really means is there's a 70% chance they can meet all of their needs without ever having to lift a finger and make any adjustments to their plan. However, there is a 30% chance, which is not insignificant, that at some point they'll need to make some tweak. They'll need to make an adjustment to how they're spending money. They'll need to make an adjustment in terms of going to get another part-time job and creating some income. They'll need to do something in 30% of the instances. Now, most retirement projections begin and end here when looking at risk. You say, what's the risk? Well, you say, okay, well, what's the Monte Carlo analysis say? What's the probability of success based on all kinds of different market environments? That's not all of the risks. The market is not the only risk. And so what we want to look at is, what are the 7 core risks that I think everyone should look at when it comes to their retirement strategy? So this page here shows us what those risks look like for Chris and his wife. Now, these numbers are going to be specific to them. By the way, a lot of people, when they watch this, say, how do I get access to the software? This is available in my Retirement Planning Academy. So take a look in the comments if you want to know how you can get access to the software. This is included there. So that's that. You can go through that on your own. But for Chris, what you can see here, here's the baseline probability of success. So let's stress test this. To Chris's question, hey, things look good. Things look rosy. It looks like we're going to be just fine. But what are the things that we need to be aware of? What are the actual risks that could potentially derail this? Well, what you can see here is we're going to identify 7 core risks. Those 7 core risks are, what if the equity markets drop immediately? So Chris and his wife retire, markets drop day one by 20% in this scenario. Versus another risk. What if Social Security is reduced? And you can see here, we can toggle this to different percentages. I'm just using 20% here as a baseline. What if inflation is higher? What if asset returns as a whole over the entirety of retirement are lower? What if taxes go up by 20%? What if you live 5 years longer? What if healthcare costs are higher? So this isn't to say these are the only risks, but these tend to be 7 core risks that most people, I'd venture to say almost all people, face when it comes to retirement planning. So as we go through this, I want to help you understand, how would each of these things actually impact the probability of success for Chris and his wife. But more than that, we want to understand, what can we actually do to alleviate this? So what if the market dropped immediately by 20%? So take the value of investments in the stock market drop by 20% and then continued growing from there. Well, that absolutely has an impact on the probability of success. 70%, you could argue that's okay going into retirement, given it's such a long retirement, you just have to know there's a good chance they're going to make some adjustment along the way. And at 56% probability of success, you may or may not be so certain. So that's certainly a risk. What if taxes go up? What if Social Security decreases? And you can see here the impact of that. Longevity, and you can start to see the impact. And what we want to know is, which are the greatest risks to Chris's plan? Which are the greatest risks to anyone's plan? Because these aren't all going to show up the same way for each person. Depends upon the type of income sources you have, depends upon your age, it depends upon your market exposure, it depends on a whole number of things. But what we can see here is inflation being higher and asset returns being lower are the primary risks to Chris and his spouse. So what can we do with this information? Well, there's a few different things, and let's go through them in order. The first thing is a market drop. What can you do? Well, number one, invest in the right asset allocation. With a market drop, there tends to be this thinking that, okay, if there's a market drop, it's going to hit everyone who's retired. There's no way around it. Well, not necessarily. The market is going to impact whatever investments you have in the stock market, but what if not everything you own is in the stock market? Now, that sounds obvious, but when you invest and when you determine your asset allocation strategy, you have a mix at a high level, at least, of stocks to bonds. Now, this isn't just to say you're retired, you should have a 60-40 portfolio or 50-50 portfolio or some cookie cutter solution like that. Instead, you need to understand what percent should you have in bonds that's completely insulated from the impacts of the stock market. And when I say completely insulated, we need to understand that not all bonds are created equal. In a year like 2022, for example, the stock market, the S&P 500 was down almost 20%, and bonds, an aggregate bond portfolio, was also down double digits if it was holding just all bonds. Now, if you have a very short-term bond fund, that provided a lot more protection. So do you have the right mix of reserves, of things that are going to be there for you regardless of what the stock market does, things that are highly liquid, so that when there's a downturn in the market, not if, but when there's a downturn in the market, do you have the right asset allocation that gives you options of what assets to pull from? Do you pull from stocks? Do you pull from bonds? Whatever you answer to that, what types of bonds do you pull from? What types of stocks do you pull from? So having the right asset allocation up front that gives you the options to have different types of things to pull from. That is then followed very closely by number 2, implement the right withdrawal strategy. It's not enough just to have the right asset allocation. If you're withdrawing money from the wrong places, that asset allocation is maybe not serving you too well. For example, and this maybe sounds like an obvious thing, but let's assume that you have a 60-40 portfolio and stocks are down big and bonds are, let's say, flat on the year. Well, if you're pulling proportionally from stocks and bonds in your portfolio, you're doing yourself a disservice. If stocks are down and bonds are stable, maybe that's when we pull money from the bond allocation. So that's what I mean by the withdrawal strategy. Where are we going to pull money from? Not just what specific asset, but even the specific account that you're pulling from. So how do you protect against the market drop that will come multiple times over your retirement? Number 1, invest in the right things that give you optionality of where to draw from in retirement. And then number 2, implement the right decisions when it comes to where you withdraw from the right asset, from the right account. So market drop was the first risk that we looked at. The second is taxes. So how can you protect against taxes increasing over time, which, by the way, is something that none of us have any control over? Well, number 1, you diversify your tax allocation. In a second, I'm going to show you what I mean by that. And number 2, strategic income shifting. So tax allocation, what does that mean? So here's an example of what I mean by that using Chris's actual plan. This is a breakdown of Chris's portfolio. You can see of his portfolio, 2.1 to 2.2 million is taxable. What does taxable mean? Well, it means it's in a brokerage account. 529,000 is tax deferred, meaning he took a deduction on that money, like a 401k or traditional IRA, but he'll pay taxes on the back end. And then finally, he has tax-free assets. So these are things like the Roth IRAs or even health savings accounts. Now, something to notice here is he actually has very little exposure, relatively speaking, to pre-tax or tax-deferred assets. That's the account that has 529,000 in it, or the combination of accounts that have 529,000 in them. Where there's a lot more risk is if hypothetically all these assets were in a pre-tax 401k, which, by the way, is a lot more common. 401k is probably the easiest place to build wealth. Contributions are pre-tax typically. Contributions are automatic. You get a matching contribution, which is pre-tax. That starts to grow. That starts to build wealth pretty significantly. And all of a sudden, you have a lot of money, but it's all in a pre-tax account. Why do I say that? Well, that presents a lot of risk if there's a significant tax increase down the road. If your effective tax rate increases by 10% or 20%, that proportionately decreases the value of that account to you. So number 1, when I say diversified tax allocation, this is what I mean. How much do you have in taxable assets, tax-deferred assets, tax-free assets? Then number 2, how do you practice strategic income shifting? What that means is Roth conversions. Roth conversions is this term that just says, how do we shift when we want to realize income? If Chris were to have a lot of his money in tax-deferred accounts, maybe even if not, if he has any money in tax-deferred accounts, are there years when income is much lower that he can shift some of those assets into Roth accounts so that all future growth is tax-free and future tax increases don't have a negative impact on that portion of his portfolio? The third risk that we talked about is Social Security reductions. What happens if Social Security is reduced? And by the way, as of now, if no changes are made, it's not an if, but a when. What happens when Social Security gets reduced, assuming that no changes are made to the program? Well, the first thing that you need to understand is you need to understand what that does to impact you or how that actually impacts you. So when I say run what if scenarios, that simply means be aware of what would your plan look like if Social Security were to be reduced. For some people, this has a really heavy impact on their plan. That typically is going to happen to the person who has the majority of their retirement income coming from Social Security. That makes sense. If your retirement budget, let's say, is $3,000 per month and $2,500 per month is coming from Social Security, if Social Security drops, a majority of your paycheck is actually going away. Versus someone like Chris, well, Chris is even going to have Social Security for the next 25 plus years because he's retiring at such a young age. And even at that time, his portfolio balance is going to be significantly greater in terms of the income that it can produce than his Social Security benefit would be. So in Chris's specific situation, Social Security reduction isn't that great of a risk, but for a lot of people who are already retired and who have a big portion of their monthly income coming from Social Security, you have to understand what would things look like if/when reductions or changes do happen to Social Security. The second thing you can do, point number 2 here, is build your liquid reserves. What does liquid reserves mean? Well, it means not necessarily just cash, but build your portfolio. Save to your 401k, save to your Roth IRA, save to your brokerage accounts. Make sure that you have assets that you do fully control that aren't subject to Social Security reductions. So make sure that you're prepared for what might happen if your Social Security is reduced by having assets elsewhere that can create income for you. The next risk, and it sounds odd to call this a risk, but longevity is a risk. If you're going to live to 100 or 110 or 120, especially if you're like Chris and his wife who are retiring at age 40, it's a long time that your assets need to last for you. Now, what are some things you can do? One traditional approach is to maximize your Social Security benefit. Now, we just talked about Social Security being a risk, but Social Security is also a tremendous asset. It's a tremendous income source that helps to fund a lot of people's retirement. Now, one thing you can do to minimize the risk of longevity is to maximize that benefit. Social Security is a social insurance program, meaning the longer you live, the greater that benefit becomes because that's an income that you're going to receive for the rest of your life. So having a higher income amount, obviously, is a way of offsetting the risk of longevity. The second thing you need to do is you need to use the right investment time horizon. What do I mean by that? Well, so many people think, okay, I retired, therefore I need to become more conservative with my investments because I'm retired. I've reached the goal. Well, when you're 65, you might still have another 30 plus years ahead of you. If you have a lot of longevity, you might have 35, 40 years ahead of you. If you are too conservative with your investment mix, those assets are not going to last as long as you need them to, and that becomes a tremendous risk. So make sure that you're using the appropriate time horizon, not thinking of retirement as the end, but really as the beginning of a new phase of life where you still need to have your assets continuing to grow for you. The next risk is inflation. What can you do? Well, focus on the right risks. Why do I say this? Well, up until maybe recently, inflation wasn't top of mind for enough of us. When we thought of the word risk, especially as a retiree, you're probably thinking of images of the 2008 Great Financial Crisis. You're thinking of big downturns in the stock market. That is a risk. I don't want to minimize that. But that is a risk that, although painful, is temporary. 100% of the time, the stock market has fully recovered and continued growing. Cannot predict the future, say with certainty that's going to continue, but chances are very good that if history is any indication, those downturns will always happen and they will also always be temporary. So yes, that's a risk that we need to protect against, but the bigger risk, a risk that's not temporary, is inflation and what inflation does to our purchasing power. If you have a portfolio that's too conservative, so cash in the most extreme case, that portfolio is not going to go through the ups and downs when the market's fluctuating quite a bit. So it's going to feel good in the short term, and you're going to feel protected against one risk. But the bigger risk is the risk of inflation. The cost of everything is going to double, triple, potentially quadruple over the course of your retirement. And if your assets aren't growing, then that becomes a permanent loss of purchasing power. And that is an enormous risk that people don't think enough about. So number 2, the second thing you can do is own assets that outperform inflation. Well, simple enough, but what does that look like? Well, here's a historical look at how the stock market has done as measured by the S&P 500 versus how long-term government treasury bonds have done. If you just look at $1 invested in 1926, so almost 100 years ago, that single dollar invested in the S&P would have grown to about $17,500 today. That same dollar invested in long-term government bonds would have grown to $118 today. So what do you notice? What you notice is that the things that offset inflation are stocks. Yes, stocks are more risky in the short term because they fluctuate more in the short term. But over time, if real risk is determined by the erosion of our purchasing power or the loss of our purchasing power, stocks should maybe more appropriately be labeled the anti-risk, the thing that prevents the risk of inflation eating too much of our purchasing power. Now, we looked at these numbers, 17,500 versus 118. The interesting thing is if you look at inflation adjusted returns, yes, that's quite a good return. We look at the bonds here, $1 to 118. But if we look at the inflation adjusted returns of bonds, $1 has only grown to $6 since 1926. So while bonds have their place in a portfolio, their place is not to offset inflation. It's not to outpace inflation. They do a very poor job of that. Stocks, even after accounting for inflation, $1 is still worth well over $1,000 today after inflation. So when we go back to what do? Own assets that outperform inflation. One incredible asset that does that is stocks. The next big risk that all retirees face is healthcare and the cost of healthcare increasing. What can you do? Well, diversify your tax allocation. We talked about this previously. This also applies to healthcare. Now, one of the ways you can do that is by having assets in a health savings account if you're eligible because you have a high deductible health plan. But even if you don't, diversifying your tax allocation helps in other ways. You can receive a subsidy for your health insurance premium if your income is under certain limits. Now, when you're retired, you can control the way that your income is realized. If you have diversified your tax allocation, you might have some money in brokerage accounts, some money in tax-free accounts, some money in tax-deferred accounts. And by being strategic, you may be able to pull money out in the right way to keep income under certain thresholds, which allow you to qualify for health insurance subsidies. So that's a way to help offset potential increases of that cost. But number two, and so often we get to thinking of, okay, what are the things we can do from a financial standpoint to save on cost? Well, think big picture. The best thing that you have, the only thing that you have in some cases is your health. If you don't have your health, you can't enjoy everything else that retirement has to offer. So one, take care of yourself so you can actually enjoy retirement. But two, if you want to minimize healthcare costs, the greater care we take of our bodies and of ourselves today, the less dependent we're going to be, or the less likely we'll be to have some of those major health issues down the road that end up draining some of our resources. And then finally, asset returns. What can we do to protect against this? Well, number one, retire debt-free. This isn't a universal thing. You can retire with debt and still be just fine. But if asset returns are much lower, well, the less we have in expenses that we're committed to, the better off we're going to be. If we have a lot of our portfolio in assets that aren't returning what they have historically, and we have significant burdens in terms of our monthly expenses, that's going to be a difficult thing to reconcile. But if our monthly expenses are lower because we have a retirement where we don't have a mortgage, we don't have debt, then it's going to be much easier for that same portfolio balance, all else being equal, to be able to cover that. So again, that's not a universal thing, but generally speaking, the lower our expenses are, the less dependent we're going to be, or the less vulnerable we're going to be to lower asset returns going forward. Second thing, Chris did a good job of this. He has his core expenses and he has discretionary expenses. If you recall, he has his core expenses of $8,000 per month, plus an extra amount for the first 30 years or so to fund the go-go years. Now, if you have those things dialed in, that makes it easier to say if asset returns are lower, if the market's not doing what it has done historically, I know what expenses I can't cut versus I do know what expenses I can cut, even if just temporarily. But number three, and probably most importantly, is monitor your progress. Asset returns don't ruin your retirement overnight. It tends to be a progression. What you'll see is something like this. So this is Chris's plan or snapshot of his plan of here he is today. And what this is showing is this is showing the asset simulation or the potential range of returns of what his portfolio might be able to look like. So when we run a Monte Carlo scenario or an analysis, there's 1,000 different scenarios that are run. And we want to know on the upper end, what does it look like if Chris retires and things go really well versus what if Chris retires and things go really poorly? And then the median line is this darker blue line right here. So this is showing the 25th percentile to the 75th percentile. So in other words, if we get fairly normal results, there could still be a wide variety of potential outcomes. What you will see though is even in the 25th percentile case, so on the lower end, it's not like all of a sudden Chris and his wife ran out of money. What you see is here they are, here they are, here they are. They're starting to trend lower and lower and lower. And by the age of 70, the age of 75, they're probably thinking, you know what? We're getting to the point where we might need to make some changes here. Now, this isn't going to be the exact way that everyone's graph looks like, but this is something that requires ongoing monitoring. You don't look at your asset returns and just wake up one day and say, hey, we have no money left. What happens is if you're not careful and you keep spending while asset returns are lower than they've been projected to be, that's where you might run into some issues. So as we go back to Chris's plan, you can start to see here are those different risks. And again, everyone's plan, and based upon the specifics of it, your vulnerability to some of these might be different than Chris's vulnerability to some of these. So run your own scenarios, run your own plan. And again, you can get this from Retirement Planning Academy and get the same exact access to this. But when you go through it, the most important thing is you can start to go back to your plan. You can start to say, what would this look like? What are some of the things that I can do to offset this in order to make sure that I'm retiring with the type of confidence that I would like? So for example, you can run, what if you work a little bit longer? How does that impact things? We talked about the impact of discretionary expenses. What if Chris said, well, you know what if I cut out all discretionary expenses? I don't want him to do so. I hope he doesn't have to do that. But what if I cut out that early extra spend? What does that do in terms of my probability of success? And when you have this information at your fingertips and you can understand both the types of risks that exist, then the most important thing from there begins to understand what are the things that you can do specific to your plan to make sure that those risks are mitigated as much as possible. So have a plan for your retirement, have a vision, have a dream, know what you want it to look like, but don't be naive to the fact that there are risks. All of us face risks. All of us have things that are outside of our control. The key isn't to fully eliminate them. That's impossible. The key is to understand where they exist and to start to understand what things you can do to mitigate them as much as possible. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.